Hi, and welcome to the MENA market briefing. Today is the 5th of August, and today we're going to be taking a look at high-level global supply-demand forecasts from 3 major energy agencies. This data will give us an indication of what the market could require from OPEC producers over the next 12 to 18 months. We will then compare this data with the current OPEC production and policy commitments. And finally, we will see how the market is factoring this into price expectations for this year and next. Stay with us. The global crude prices are starting to show some weakness, finally, after many months of high-level trading. Front-month Brent futures appear to be grinding through long-term resistance of around $97 per barrel, and as of this morning, it's GMT 0900 on the 5th of August, Brent was trading towards a $94 level. Key demand-side factors feeding bearish sentiment include rising interest rates, strong US dollar, and global inflationary pressures, which are eroding purchasing power and softening the demand outlook for the fourth quarter of 2022. Of course, there exists a great deal of supply-side uncertainty still. The Ukraine conflict is still ongoing. International sanctions are affecting international trade in Russian oil products, but the overall impact on crude exports has so far been quite negligible. Nonetheless, the risk of unplanned outages remains high due to low global inventories. OPEC is finally nearing the end of its COVID production cuts and has now volunteered a further 100,000 barrels per day to its September production quota, following a meeting of OPEC Plus members in early August. Now, this is going to be the focus of what we want to talk about today. So here we have quarterly supply demand forecasts, which go out to the end of 2023. And these are from 3 major energy agencies, including the EIA, the IEA, and OPEC itself. Now, for all the talk of recessionary fears, the chart on the left there shows that global oil demand is in fact expected to increase in the 3rd quarter and the 4th quarter of 2022. So we have the mean of the 3 agency estimates, which shows demand is expected to rise to 101 million barrels per day in the 4th quarter of this year, and then to 104 million barrels per day in the 4th quarter of 2023. And that's the magenta line you see here. Now, interestingly, OPEC, this is the black line, it's the more bullish of all the agencies on global oil demand. And if you look at its data and latest July estimates, it's got demand at 102.8 million barrels per day for the 4th quarter of this year. The IEA, that's the green line, this is the more conservative of the 3 agencies. They're forecasting 100.2 million barrels per day for the 4th quarter of 2022. And even the IEA is forecasting global oil demand growth over the next year or so. So that kind of says a lot about where the agencies are seeing global demand in the context of the recession narrative, or the forthcoming recession on a global basis. If we turn over to the supply side here on the right-hand chart, agencies are forecasting quite a significant jump in non-OPEC supply in the current 3rd quarter of 2022. We see 3rd quarter 2022 from 2nd quarter 2022 there. And then following that jump, we expect to see marginal growth in non-OPEC supply over the subsequent 15 months to the end of next year. So if we look at the supply outlook for 2023, we can actually see quite strong divergence between the bullish OPEC and the slightly more bearish or conservative IEA. You see the top there, the black line is OPEC, and the IEA in the green here at the bottom. Mean estimates, more or less in line with the EIA there, they show 1.3 million barrel per day increase in the 2nd and 3rd quarter, followed by a net increase in output of 0.7 million barrels per day to the end of 2023. That's for non-OPEC supply. So we see the big jump happens in this period here to the end of this year, and then subsequently growth is somewhat even and steady, rising a total of 0.7 million barrels per day through next year. So this compares to a mean global demand growth estimate of 3.3 million barrels per day through the same period, which implies a rising call on OPEC through the forecast period, and we can see this in the bottom of the table here. Second quarter at 27.8 million barrels per day, rising to 29.1 at the end of the fourth quarter of this year, and on to 30.7 million barrels per day at the end of next year. Now, if we look at demand estimates, well, here's this data for the forecast July versus June. So we're going to see what's changed from month to month in terms of the agency outlooks. If we look at the demand estimates for the second half of 2022, all agencies have taken a more bearish tone in their July report. We see Q2 2022 there. The average coming down through this period in the IEA, revising their estimates or demand estimates for that time down considerably by about 400,000 barrels per day. And they've done the same again for the third quarter of 2022 as well. This implies that the IEA sees stronger macro headwinds up ahead, certainly than it did in the May-June period. But recession does not appear to be a part of their base case scenario at present. On the supply side, there's a more optimistic note, I'd say, particularly from the US EIA there, you can see. They've put in a substantial upward revision for its non-OPEC supply estimates. And if you look at OPEC, it's actually trimmed its estimates for that period slightly. Now, if we compare the monthly adjustments, we can see there's, broadly speaking, upward revisions to non-OPEC supply. We do have downward revisions to global demand. And on a net basis, this essentially shows that the agencies, the mean of the agency estimates, expect higher non-OPEC supply growth. Well, they revised their estimates on non-OPEC supply growth higher than the downward revisions on their global demand growth, and this essentially narrows the call on OPEC. You see here in terms of where they were a month ago. So they revised down their call on OPEC estimates versus the June period. So, as we mentioned a short while ago, between now and the end of 2023, global demand growth is expected to outpace non-OPEC supply growth. This is evident in the call on OPEC, which is essentially the production target OPEC must aim for in order to maintain a balanced global market and maintain its role as the global swing producer. The mean of the agency estimates here shows OPEC production needs to reach about 28.2 million barrels per day this quarter, rising to 30.7 million barrels per day at the end of 2023. So here we have Q3 2022, 28.21, 29.1 million barrels per day they must produce in the fourth quarter. Come Q4 2023, current estimates show a requirement around 30.7 million barrels per day for crude oil production, that is. So the question then becomes whether or not OPEC can actually meet these production targets, and we're going to examine that a little bit more closely now. So this table compares data for OPEC production quotas, OPEC output, and compliance for July. Now, the first data point we need to observe is the total baseline production, which you see here is 32.45 million barrels per day. Now, this is a revised baseline from which the production cuts are actually gauged. And essentially what it implies is that the producer group has a proven and sustainable production capacity, which exceeds the maximum monthly call on OPEC of 32 million barrels per day, which is forecast by OPEC for the fourth quarter of next year. Okay, so even in the best case scenario currently presented by the agencies in their forecast data, we see that historical production capacity by OPEC is sufficient to cover the requirements over the next 12 to 18 months. Now, that's a good start for balancing production capacity versus demand through the forecast period. We then look at total production for July. That was here, nearly 29 million barrels per day. And this is actually 1 million barrels per day above the highest call on OPEC estimate for the second quarter of 2022. That was set by OPEC itself at 28 million barrels per day. So based on the three agency supply demand estimates and the polled production estimates, which is this data here, OPEC actually produced enough oil in July to bridge the gap between non-OPEC supply and global demand, and potentially actually leave the market in something of a surplus. Now the market, so in terms of Brent futures anyway, is trading October deliveries, and by October we see the pledged cut, which as of July was 800,000 barrels per day. That moves to 400,000 barrels per day in August and rolls off by September. In September, OPEC has now agreed to increase production by 100,000 barrels a day in September. So what that means is that by October, which is the delivery date we're currently trading in Brent futures, the front month anyway, the baseline should rise to 32.55 million barrels per day. Okay, now this exceeds the most bullish call on OPEC estimate of 30.5 million barrels per day for the fourth quarter, and essentially technically puts the market in a surplus by a considerable margin. We're talking 2 million barrels per day, technically speaking, on paper anyway. So what this means from a political decision-making perspective is that OPEC's collective production target is over and above the requirement to actually balance the market, and that's for three agencies. Okay, so the issue then comes whether or not they can actually reach this target. Now the data here shows that the group as a collective missed its production target by 0.88, so 900,000 barrels per day, more or less, in July. Now, obviously, we can see are marked in red here the countries which have missed their targets. Mostly for West Africa, it's quite unusual actually to see Iraq was below target. It's been one of the highest producers and perhaps guilty of non-compliance in the past, but people are probably not going to be so critical of that these days. But yeah, we clearly see African producers clearly unable to ramp up production, and that will not change, or is unlikely really to change in the forecast time horizon that we've been talking about here. So this means that Middle East exporters will have to ramp up production over and above the quota allowance. I mean, you can see here, you know, Saudi, UAE, all marked in green, Kuwait as well. They actually overproduce relative to their quotas, but the likelihood is that in order to make up for this deficit of the West African producers, which potentially could actually increase as the quotas sort of roll off entirely, these Middle East producers are going to have to do more. It's a question of not whether they can. So numbers on spare capacity, that's been it's been at the forefront of market conversations for some time now. This is not a surprise to us. We've been monitoring this for a considerable period of time already. We did a session on this, a podcast on this late last year, in fact, highlighting the issue for the West African producers. So we know this is coming. So it's a question of how it's tackled. That's also why you're seeing the political pressure from particularly the Western governments and the visits by Joe Biden to encourage particularly the UAE and Saudi Arabia to ramp up production, as they are the only countries that are considered to have any meaningful spare capacity. What that spare capacity is open for debate, obviously. Now the EIA has some numbers on this. It's available on Refinitiv Icon. I think they're kind of around 3.5 million barrels per day in spare capacity at the moment. But OPEC actually addressed this in its latest meeting, and it's quite rare for them to do so. And I think the numbers or the estimates for spare capacity and sustainable spare capacity came in around 2 to 2.5 million barrels per day. Now, the justification for not actually increasing production beyond the 100,000 barrels per day, which in the market, in the grand scheme of things in global market, is somewhat meaningless. The reason for not doing so is that they want to reserve that spare capacity for potentially times of distress. So that's where OPEC are standing in terms of their August meeting. So let's try and sort of understand what this situation means for the price outlook going forwards. Action taken by OPEC members to increase production above and beyond their quota will obviously be critical in balancing the global market through the forecast period of the next 18 months or so. Now, poll data puts average price estimates for Brent at around $100 or over $100 per barrel out to spring 2022. This is the line we're looking at here, this data. Okay, that's the mean of the poll data available on Icon via Reuters. The longer term price estimates, if you look below here, the years out, they seem to be driven more by the forward curve, and this is the Brent forward curve in the blue, by the DME Oman there on the bottom chart, the bottom line. They appear to be sort of driving the longer term price forecast. It's probably the best gauge that analysts have really for any meaningful signal that far out. But what is critical is that this futures curve remains in quite steep backwardation right along the curve, which itself creates challenges for commercial inventory builds, which really considerably low. And then you've got SPR on top of that, which is also at record lows. And what that means, obviously, is that as the market will remain vulnerable to supply shocks with limited short-term cover in the event of a supply outage. Now, Russian exports, they seem to be holding up relatively well at the moment, as I mentioned earlier, but supply disruptions remain a major risk given the geopolitical fragility almost and uncertainty as a result of the Ukraine crisis. You can alternatively look to the JCPOA, the US-Iran nuclear talks, and say that, again, we've done episodes and podcasts on this over the last 12 months, and I can't say that much has changed. There was some original bullishness there early last year, but they seem to have backtracked, and we've had a change in administration in Iran as well. So you have to think that the likelihood of a return of Iranian barrels, which could introduce an incremental increase of about 1 million barrels per day in crude exports, that seems to be at this stage a medium-term possibility rather than a short-term probability. So it's really a case of seeing what the diplomats can achieve on that front. So further action of Saudi Arabia and UAE to boost production is likely to be necessary over the next 12 months in order to prevent a shortfall in OPEC production, which is really stemming from those West African producers we just discussed. So given the availability of spare capacity, the willingness to actually tap into that, and the potential that leaves for shortfalls and supply shocks, you have to argue that this is, generally speaking, quite supportive of benchmark prices over the next 6 months or so, although the market at this point does appear to be softening considerably on the front month anyway, due to the macroeconomic concerns and headwinds that are creating softness in many asset classes at the moment. So if the group can hit its target as a collective, OPEC as a group can hit their target as a collective, there should be sufficient supply to keep the global market balanced. And that's implied here by the EIA supply-demand deficit from its current forecasts, which has to say it assumes that OPEC will meet its quota. But again, that is in question, and in order to do that, it's probably likely that they're going to have to adjust their quota systems, sharing that supply or the production target among the members evenly is not going to yield the results necessary to meet or to fulfill that role as a market manager. So on that note, ladies and gentlemen, a lot for consideration. Thank you for joining us, and we'll be with you again with some more insights. Look forward to it.